Hello and welcome back to our channel, where we explore the strategies and insights of legendary investors. In today's video, we dive into Benjamin Graham's Value Investing Secrets, a set of principles that can unlock profitable investments. From investing with a margin of safety to seeking companies with a competitive advantage, these principles provide valuable guidance for achieving long-term success in the dynamic world of investing. Explore these secrets and take your investment strategy to new heights. If you're new here, make sure to hit the subscribe button and turn on notifications so you never miss a video. We're all about providing valuable content to help you improve your financial literacy and achieve your goals. So don't forget to subscribe and let's get started. Principle number 1. Invest with a margin of safety. It means taking precautions to protect your investments and minimize the risk of permanent loss. It involves buying stocks at a significant discount to their intrinsic value, providing a cushion against potential downturns or unforeseen events. As Benjamin Graham famously said, "The essence of investment management is the management of risks, not the management of returns." This principle urges investors to prioritize the preservation of capital over excessive focus on potential gains. By investing with a margin of safety, you are essentially building a protective barrier around your portfolio. It allows you to weather market volatility and provides a buffer against potential downturns. This approach aligns with Graham's philosophy of emphasizing the long-term value of a company, rather than short-term market fluctuations. How can investors determine the margin of safety in a particular investment? Is there a specific method or metric to rely on? Evaluating the margin of safety requires a thorough analysis of a company's financials, market conditions, and potential risks. It involves comparing a stock's current price to its intrinsic value and assessing the overall market sentiment. By adopting this approach, investors can make more informed decisions and mitigate the potential downside risks in their investment portfolios. Principle number 2. Conduct thorough fundamental analysis. It is the cornerstone of successful investing. It entails a diligent examination of a company's financial statements, market position, competitive advantages, and growth prospects. As Benjamin Graham once stated, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. This quote highlights the importance of in-depth research and analysis before making investment decisions. By conducting thorough fundamental analysis, investors gain valuable insights into the financial health, intrinsic value, and potential risks of a company. It enables them to make informed judgments about the viability of an investment opportunity and assess its long-term growth potential. What are some key components of fundamental analysis that investors should focus on when evaluating a company's potential for investment? Fundamental analysis involves examining a company's financial statements, evaluating its competitive position, analyzing its industry trends, and assessing its management team. By understanding these factors, investors can make more informed decisions about the financial health and growth potential of a company. Principle number 3. Focus on intrinsic value. It involves determining the true worth of a company based on its underlying fundamentals, such as earnings, assets, and growth prospects. Graham emphasized that investing should be based on buying stocks when they are priced below their intrinsic value, stating, "The intelligent investor is a realist who sells to optimists and buys from pessimists." By focusing on intrinsic value, investors can potentially identify opportunities where the market has undervalued a company's stock. This approach requires a thorough analysis of financial statements, industry trends, and other relevant factors to estimate the intrinsic value accurately. How can investors assess the intrinsic value of a company's stock? Are there specific methodologies or ratios to consider? Investors can use various valuation techniques, such as discounted cash flow, DCF, analysis, price to earnings, PE ratios, price to book, PB ratios, and comparable company analysis. Each approach has its strengths and limitations, and investors should consider multiple factors to arrive at a comprehensive evaluation. By focusing on intrinsic value, investors can potentially uncover investment opportunities that the market has overlooked. So, what are your thoughts on determining intrinsic value? Do you rely more on quantitative or qualitative analysis when evaluating a company's worth? Share your insights in the comments section below, and keep watching the video to explore further investing secrets. Principle number 4. Emphasize long-term investing. Graham believed that short-term market fluctuations often led to irrational decision-making, and overlook the true value of a company. As he wisely stated, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Why is long-term investing important for value investors? Long-term investing allows value investors to focus on the intrinsic value of a company, giving ample time for the market to recognize and reflect its true worth. What are the potential benefits of adopting a long-term investment approach? A long-term approach enables investors to ride out short-term market volatility, capitalize on compounding returns, and take advantage of the underlying growth potential of well-managed companies. By taking a patient and disciplined approach, investors can resist the temptation of short-term speculation and align their investment decisions with the long-term prospects of a business. Principle number 5. Diversify your portfolio. It involves spreading investments across different asset classes, industries, and geographical regions to reduce risk. Graham believed in the importance of not putting all your eggs in one basket, as reflected in his advice. The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. Why is diversification important in investing? Diversification helps mitigate the impact of individual investment losses by spreading risk across multiple assets, potentially preserving capital and reducing overall portfolio volatility. How can investors achieve effective diversification? Effective diversification involves investing in a mix of assets with low correlation to each other, including stocks, bonds, cash, and potentially alternative investments. It's also important to diversify within each asset class by investing in different industries or sectors. By diversifying their portfolios, investors can potentially achieve a more balanced risk-return profile. While diversification cannot eliminate all investment risks, it can help protect against severe losses from individual investments or market downturns. Principle number 6. Maintain a disciplined approach. It involves sticking to an investment strategy and avoiding impulsive decisions driven by market sentiment or short-term fluctuations. Graham wisely stated, "The investor's chief problem, and even his worst enemy, is likely to be himself." Why is maintaining discipline important in investing? Maintaining discipline helps investors stay focused on their long-term goals, avoid emotional decision-making, and resist the temptation to chase short-term trends that may lead to poor investment outcomes. How can investors cultivate and maintain discipline in their investment approach? Cultivating discipline requires setting clear investment goals, establishing a well-defined investment strategy, and adhering to a consistent decision-making process. It also involves regularly reviewing and reassessing investments based on fundamental analysis rather than succumbing to market noise. By maintaining discipline, investors can resist the urge to chase quick gains or succumb to fear and panic during market downturns. Instead, they can make informed and rational decisions based on their investment principles and stay on course towards their financial goals. Principle number 7. Seek companies with a strong competitive advantage. It is a crucial aspect of successful investing. Benjamin Graham emphasized the importance of investing in businesses that possess sustainable competitive advantages, as he believed they were more likely to generate long-term profitability and withstand market fluctuations. As Philip Fisher stated, "The stock market is filled with individuals who know the price of everything, but the value of nothing." Companies with a strong competitive advantage have unique qualities that set them apart from their competitors. They may possess a recognizable brand, proprietary technology, superior distribution networks, or economies of scale. Such advantages create barriers to entry for competitors and allow these companies to maintain market share and generate consistent profits over time. How can investors identify companies with a strong competitive advantage in today's dynamic business landscape? Are there specific indicators or metrics to consider? Identifying companies with a strong competitive advantage requires thorough research and analysis. Investors can assess factors such as a company's market share, brand recognition, product differentiation, customer loyalty, and barriers to entry in the industry. In conclusion, Benjamin Graham's value investing secrets offer timeless wisdom for profitable investments. By emphasizing the importance of a margin of safety, thorough analysis, competitive advantage, long-term focus, diversification, and disciplined approach, investors can navigate the market with confidence. Incorporate these principles into your investment strategy and unlock the potential for long-term success. If you enjoyed this video and found the information valuable, We kindly ask you to like and subscribe to our channel. By subscribing, you'll stay connected with our future content on investing, personal finance, and wealth management. Don't forget to press the bell icon to receive notifications so that you never miss any of our upcoming videos. Best of luck on your journey, and may your financial goals be realized.